All right, Dima, we're live on YouTube, so you hold it as I get this together.
All right. Hey, everyone. Thanks for joining us today. There's a disclaimer right behind Will. Remember, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas here.
Thanks for joining us, everybody. We're having a little bit of a snafu trying to get both YouTube and the Zoom going. Just give us a second here before we go live to the webinar. Thanks for holding in with us.
Hope everybody had a great weekend.
Yeah, it was. I don't know about you, Dima, but I was at the beach. It was tiring.
Yeah. Being on the sun definitely drains all your energy.
And gets your face red. My face is all red.
Yeah.
All right, let's get that report out.
Okay.
All right, well, hopefully that gets us going. Now we're about to go live. All right, we're starting the broadcast. Hey, everybody. Thanks for joining Dimitri and I for tonight's special episode. Sorry we're a little late getting started. For everyone's knowledge, chat is down at the bottom. Right now, I'll put in where I'm from. I'm from Bucks County, PA. My name is Will McBride. The other man on the screen's Dimitri Pargamonic. And Dima, where are you from?
Philadelphia, Center City.
Philadelphia. You've
Yep.
had some interesting stuff going on down there. Let us know that you can hear us. I know my voice isn't great, but if you don't hear me, let me know if there's some sort of technical issue. The chat is on your right-hand side or down at the bottom. Ask all questions for the end of the show in the Q&A. I'm going to put up a little poll right now. Do you use seasonality statistics in your stock and options trade? And let us know. I'm launching it. That helps us design things, gives us ideas, just generally helps us out. And with that, Dima, you have anything else? Do you want me to share the disclaimer, or is it all right just behind me, you think?
Yeah, I mean, if you want to do it like really quickly, we'll just run it by and just tell everybody that they know we're not registered investment advisors or broker dealers. We're not telling you guys what to do. We're not making any recommendations. We're sharing ideas. The disclaimer is right behind Will. I think then it's fine, and I could share my screen if you're ready, Will.
Yeah, let's go.
All right. Yep. So let me just let me know when you could see my screen.
It's up there and it's perfect.
All right. So thanks everyone for joining us today. And I took this. So this is a tool here under stocks. Usually I just go and talk about options and we kind of guide you through different option strategies. And today I'll really try to focus more on stock activity. And this is a tool over here, like under the stocks, price action analysis. So when you bring it up, it'll look something like this, historical price return distribution. And really we use this tool to kind of go back and look at historical stock behavior around to answer a few different questions. And that's what we're going to start going over right now. And that's important for traders because when you think about what do traders look at around stocks, and you'll hear a lot about volatility, support, resistance, trends, patterns, stuff like that, relative performance, and we'll go over some of those examples today. And right now, I just have it. This is when you come to this page is the default, and you have this symbol here. You could change. And what we first see here, I'll explain it. I'm going to start changing the parameters, but we're just seeing that IWM, and it gives us some statistics on how it usually performs in a one-day period over the last 4 years. And I'm going to go over like some of these stats before we go into different examples. And what this is saying is that IWM historically, it's been up more than down over a 4-year period. So it's up 55% versus 45% down days. This is that average of all the moves. So it's slightly positive here. This is the median of all the moves. So you see it's like 0.10%. It's slightly positive. So we know that over 4-year period, day to day, it has a positive drift, right? A positive drift. Here, this is if we took all the all the up moves in IWM over the last 4 years, the average is 0.87. All the down moves, the average is -8, almost 1%, 0.98%. We'll go into, how we could use these stats as well. And then we could see what are the big tail moves in IWM for one-day moves. So we see the largest one-day moves, 9.1% to the upside. We see the largest down moves, 13.3% to the downside in the last 4 years. So remember, these are just daily returns, just looking at, one-day returns right now. That's how it's set up. This is kind of like a cumulative distribution. So you see here in this green, and actually here, this histogram, that there is, over a long period of time, you see a slightly positive drift, right, in the market. And when you come down here, this table here, it kind of puts it in buckets to tell you, well, on this side, you have all the negative occurrences. This side, you have all the positive occurrences. So we see here that above zero, all the positive occurrences, 54.8% versus all the negative occurrences, 44.8%. Again, this is just indicating to us that it has a slightly positive drift over a longer period of time. But then we could go down, and if we're curious to see, well, how often has it increased by more, let's say 2.5%, or decreased by greater than 2.5%. So we could see those historical probabilities. So we see here that happened 3.6% of the time in our sample over here. The amount of times it went above 2.5%, that happened 2.5% of the time. So of course, now you could kind of start painting yourself a picture over here of historical distributions if you're starting to set up any type of strategy, either in options, or you want to hold a stop, or even do like a pairs strategy. Now, this table here, it just summarizes what we've seen above. So here we see that IWM, again, 55% of the currency is positive, negative 45%. Here's the average positive move, average negative move. So we see, like, when there is a negative move on average, we see that they tend to be slightly higher magnitude, negative 0.9% versus 0.87%. Here are your median moves. So the median moves are just taking those returns that are right in the middle. And that's because the averages, you could get outliers, and that will skew the entire average. So this is looking right at the 50th percentile. And now you could see the 50th percentile, that's the median. These are the absolute average moves. So this is something where you're looking at kind of like a volatility or straddle or whatever you want to do for one day. So on average, up or down, absolute moves, that's just converting all the moves, positive and negative, to all positive numbers and taking the average, because there you only care about not direction, which moves, but just the magnitude of the move in either direction. Again, that's maybe if you're trading a straddle or just trying to assess your daily risk, that's what that's for. Here you have the high move and low move in the 4-year period, and then you get your standard deviation. And again, this one table here is just showing you the biggest negative moves and the dates, and then the biggest positive moves and the dates. So you could really paint yourself a distribution of, moves here, how the violent moves, how often the violent moves are, and so forth. So this is like a really quick overview of that tool, and then we'll start changing the parameters here. And let's say, maybe we don't really care about a one-day period. Let's say we care about a 5-day hold period. So that's how you would start changing it and say, well, in the last 4 years or whatever, 1 year, you could change this around. Let's just say over the last 4 years, if I held it over a 5-day period. So this is like any 5-day period, starting from yesterday, 5 days, previous day, 5 days. So any rolling 5-day period, how did this perform? So then you could see here, these are the stats over a 5-day period, 56% up, 44% down. Again, it's showing us kind of slightly the same thing that over here, IWM tended to have a positive drift. These are slightly the average returns over that period. Here we have the average positive and average negative moves. And this kind of gives you, like, think of it when we start looking at average positive, average negative, not only do we want to see kind of which way the magnitude is skewed down or up, but it's almost like, like standard deviation moves, right? Like on average, how far away does it move to one side or the other side from the mean? That's what it's looking at. So it's similar to that, not exactly standard deviation, but similar idea over here. Also, we see here largest move over a 5-day period is 15.2% versus largest negative 24%. And here, for example, if you're trading, let's say even tails, or you're trying to figure out option spread, like, how far away, is the probability of this stock hitting a certain number. So let's just say over a 5-day period, how often does the stock move, let's say 6% away, up or down? So really quickly, you could see that that's happened historically in the last 4 years, 3% of the time, and above 6%, that's happened 2.7% of the time. So these are our observations. Yep.
Real quick, could you just show, we've had a couple questions. People really want to know how you get, like, if you landed on Market Chameleon's homepage, how do we get to the historical price return distribution report?
Sure. Yeah. So that's right here under the stocks menu. It's right here, price action analysis. So that's this tool right here.
Nice.
Yeah.
That's
how it will look. And, so I'm going really, really quickly kind of over just the functionality of the tool, and then we'll start looking at other scenarios. I'm going to switch the symbols around too. When you open this up, you have these different options. So I'm going to say, like, for example, let's just say you wanted to look at weekly returns in IWM. So in the last 4 years, what this will do is look on week to week, as of close, Friday to Friday, week to week, how does it perform? So again, you got these same statistics. You can look month to month. So monthly stats. So if you're intending to hold it over a month period, how does it usually do? So you could see here, as we expanded that hold period, it looks like, the positive drift increases, right? So here's from the weekly, just comparing the last 4 years, 57% of the observations are positive, 43% negative. These are the average returns. So let's just do that to the monthly. And we see over the longer period, those get a little bit better. Obviously, the more time you give it, the more, inflation kicks in, the order flow, the natural, just, order flow from mutual funds and so forth are kicking in. So it has a higher probability, this is what this is showing, of a positive return over a longer hold period. Now, this one, before we get into seasonality, intervals is just, it's the same idea as like weekly and monthly. Rolling days, remember, that's just whatever days you set, but intervals is like, maybe you don't want a weekly, but you just want in, 7-day intervals, right? So that's how you would change it. So say 7-day intervals, you could do that in the last 4 years, or, you wanted to expand to 10-day intervals like that. And this is a way you could compare. And another way, I like to apply to options. If you're looking at options with 10 days to expiration, that's how you would start kind of looking at it. Well, what does it usually do over a 10-day period? Here's like a drift. What is the average up move, average down move? What are the max, up moves, down moves, right? So here you could see that over a 10-day period, even though, we do see a positive drift, we see like that some of these down moves have been pretty severe, right? Compared to the up moves, or at least this one for sure. So that's, you're painting yourself a kind of like risk profile of the stock, which is really important, because if you're going to hold the stock or you're going to do any kind of strategy, you want to see from a historical guidance, historical perspective, how does that risk profile look in that stock? over a 10-day period, and then you could strategize around that. So once we get away from here, another way, let's take a look at seasonality. I know we took that poll. I didn't see if a lot of people trade seasonality, but seasonality is a little bit different because what you want to see is how does a stock tend to perform over a given calendar period, historically. So let's take a look at that here, and I'll switch symbols for now. Let's just say we go to Apple here, and let's say in Apple, we're going to do a seasonality, and we want to see historically, July's coming up. And you could just set this to any dates you want, but let's just say July 1st, to the end of July. How does Apple tend to perform? And remember, it doesn't have to perform this way, but all we're doing is looking at, well, in the absence of having any other information or any news, how has it tended to perform historically? So that's what we're looking at. And we see here that Apple, at least in the month of July, historically, had 83% positive returns over that month of July, and 17x. So here's the charts year to year. So you can see here 2 negatives, all the rest were positives. We see here that, again, average up move, down move, the up and down, and also the biggest up move, biggest down move. So that's what a seasonality would look at. And here, if you wanted to refine it, it kind of gives you even the average lowest point. So here it looks like it almost just the entire month went up. So let me see I think right up to the end, the lowest point is like right in July 2nd. So let's take a look at a different stock to give you an example. Let's see what Tesla looks like. So this would be, let's say, Tesla. So Tesla hasn't had a good July, historically a July month, right? So that's how it looked. And we see that here, the lowest point was July 8th. And let me see, maybe it looks like up here. So what if we just, let's start at July 8th, see how that improves. So it did improve a little bit there, July 19th. So again, all I'm doing is just refining it to where historically, during that monthly period, where was the best period historically versus the worst period within that month. And that's just kind of giving you a really quick way to paint yourself a picture for calendar month. Now let's go to, and we'll save questions to the end because I'll come back there and do any other examples people want to go over. But let's do another one. Let's say earnings. And let's say we had a question where how did Tesla tend to do going into earnings? Like, has it done well? Has the stock tend to run up into earnings? So let's just say, what if we looked at 10 days prior to earnings, and let's just say we'll go 1 day before earnings in the last 4 years. So you could see here, 69% of the time Tesla has gone up heading in that period into earnings versus 31 down. This is the average return. So we could scroll kind of down here. Let's see, here's all the observations. So April 29th, earnings are after the market close. So from April 16th to April 29th, this is how it did. Remember, it's after the market closed. So this would be closing out before the earnings announcement. And that's kind of like how you would answer it this way. So let's just take a look here. So 69%, it's been up for an average return of 1.18%. Let's just do around earnings. What if we just did 1 day after earnings? And 1 day before earnings, and let's say the day after earnings. Let's see how that looks. So we see here 44% up, 56% down. So you, at least by here, you've been better off just playing the prior to earnings event than the earnings itself based on these historicals. What about after earnings? So your average return was 1.4%, but not as good as just playing the prior period. But what if you just waited for the entire news to come out, let the stock, let the stock settle, and let's say we started the day after earnings, right? And just maybe went out 5 days in the last 4 years. So let's see how that looked. So that looked a little bit better, 56% positive returns with an average return of 2.26. So that kind of gives you an idea of like, if you're going to be playing it around it, like how did it do? Is the risk worth holding it through the news? Is it better just to play it like prior, just wait for the news to happen and then play it after the news? And this is gives you a really quick historical perspective of what it tended to do. Let me see what else I'm going to show you is let's say like we're comparing. Let me just refresh this here. I'm going to go back to let's pick Apple, and then we'll just take some symbols that people may have questions on. So let's say I'm comparing Apple and I want to see how did it tend to perform against the benchmark index. So I want to know over any 5-day period in the last year, let's say 3 years, how did it do versus SPY? So now we could just take a look at side by side. So we see here Apple's been up 62% of the time versus SPY 67% of those observations. So we're taking the same interval of returns, comparing them. So we see here that SPY has had more positive occurrences than Apple, but we see that on average, Apple has had a bigger positive drift than SPY. We also see that that the average moves in Apple have been wider than the SPY. So let's just kind of compare also as on a relative basis. So we see here, this is how many times in the green Apple has outperformed in those occurrences SPY versus underperformed SPY in the red. And this is the stats to that. So we see that 56% of the time Apple has just outperformed SPY period to period. So here's Apple's average return versus SPY. This is the times it's underperformed. Now, when we compare them side by side, kind of like here, let's take a look at a better picture. So this is telling us the number of observations Apple has increased versus SPY. So that's important. But what else is important is, what are the returns versus the risk, right? How did the returns of each one compare versus the risk you're taking? And we see here that Apple on average over, what did I study here? A 5-day period, it's returned 0.66% versus SPY 0.2%. What are the risks we're taking? Well, the risk is the standard deviation. How much variability do we have around that average, right? So this here is the standard deviation around the mean. So you see here that the standard deviation is higher, right? 3.94, but to normalize it, we want to take the average return divided by the unit of risk, and that's what this is here. So here we see that we get more return per unit of risk than we did with SPY, right? So in general, in relative terms, SPY per unit of risk did better over this period, over the 3-year period or a 5-day return than SPY did. What this is just showing us is, what if you did a pair strategy, how did you perform? So if during those periods, for every $1,000 in notional of Apple you owned, you sold $1,000 worth of notional in SPY, so you're notional neutral, right? Bought $1,000 worth of Apple, sold $1,000 worth of SPY, shorted it as a hedge against the market. So this is how you would have had that position was positive 56% of the time. The average return was 0.46. The standard deviation was 2.92. So this is that ratio, the Sharpe of your average return divided by standard deviation. So here, you're just been better off with Apple alone based on that, that scenario over here that we painted over here. Now, another thing you might want to do is say, well, what about during just down periods? You know, may be willing to do this because I really want to hedge myself during the down period. So when SPY, let's just look at during, because if you think, you know, the market's going to head down, how did it perform during down periods in SPY? Again, here, these are only looking at down periods in SPY. So we see that, you know, obviously SPY was, these are all 100% down periods. So there's only 12% of the time where SPY was down and Apple was up. That's what it's telling us. It's only 12% of the time that it was up. And here's the average return of, you know, Apple during those periods versus SPY. So this kind of gives you an idea, you know, if you're just how you're outperforming, you know, you outperformed with that pair strategy. So that's how it would look like, because during those down periods, that's when it really kicks in. So your return on average would have been negative 0.63% versus negative 4.8%, because here you're hedged. So this is kind of a quick overview of this tool. We had, the reason I went up, you know, I actually started just getting an unusual amount of questions around this tool, and actually a lot of suggestions around this tool. So I'm looking at the suggestions now that we're going to be adding more of these types of events, where how did it do around dividends, or even, you know, holidays or other events. And I just kind of want to do a quick summary of it and just give an opportunity for people to ask questions, and we'll just try to answer the questions coming in. So Will, do you have any
questions?
Sure.
Nushad is asking, is there a way to see which option strategy worked best for each month for a particular stock or indice?
Which option strategy tended to work? This is kind of getting away from the stock, but I don't think there's, like, you know, that question is too general, right? Can you read that question again?
Yeah, no, it's a general question. Nushad, put it in the Q&A, something maybe a little more focused on the stock, so I can try to pick that out. He did ask another question about pair trading. You entered Apple SPY as an example,
right?
And he's saying, and this, I know we never looked at particularly pair trading when we were on the floor, but he's asking, why pair trade two highly correlated symbols like Apple and SPY? I mean, obviously you just used that as an example, but he says, wouldn't it be prudent not to? But when people are looking at pairs trading, they are looking typically for highly correlated products that have maybe diverged. Are they not? I'm not.
Yeah, so there are different strategies for pair trading. I just did this really for an example, and what this is a typical example is why I used SPY, which is the market benchmark, S&P 500 versus Apple, because what here the attempt is that if you think Apple will outperform the market, right, but you think that there's market risk, so if the market goes down, Apple's going down, but it won't go down as much as the market, right? So the market might drop by more and Apple will tend to hold. And if the market goes up, Apple will tend to outperform the market. So you'll lose on that SPY hedge, but it'll be offset because Apple's earnings or Apple's returns potentially could be higher. So what this is just is a market systemic hedge. That's all this is. You know, there's no reason, you know, there's no analysis behind like this is a good pair strategy or they're correlated. This is strictly hedging market risk, right? Taking away your market risk to leave it to your stock specific risk. And this is just a real small example. You could do, you know, IWM or whatever, but there's no, you know, this isn't SPY is not, it's not a single stock, right? It's like a broad-based market index.
This is coming from Stephanie, and it could be she's asking for maybe a feature. I'm not aware of this capability in the screening, but I thought I'd mention it. She's
Yeah.
asking, can you screen for companies that have the strongest seasonal patterns at any time of the year for any current period we're in, i.e. working backwards? Like, is there a way to scan for certain seasonalities and then they can dig deeper into it?
Yeah, so if you just want a particular, like, so I'm going to show you that where you might be able to get closer. But if you're looking for just like a particular date, then you would have to do like, if you're just fooling around and putting in dates like this, specific dates, then you would have to come here. But there are seasonalities, like for example, let's just take a look at a monthly seasonality. So if you just wanted to look here, seasonality by calendar month, and I was like just interested in July, right, really quickly, and I just wanted to see at least 8 years of observations. I want to see like things that tended to go up 70% of the time, positive returns above 1%. So here, these are kind of like, you could just by month, calendar month, you could do it, or you could do it for all calendar months. So you probably kind of as your starting point, because she's using a screen, she's asking about a screener. You could
Yeah, well, there it is.
Yeah, you could do something like this as your starting point. If you're trading options, is there a question around options for?
It wasn't around options, but I would go there. Let us know. What do you?
Okay, like so. For example, we do also add a seasonality component around options. So let's just say here, I'm going to go here for, I don't know, bull put spread screener, right? So when you're in a bull put spread screener, and let's do just this. I'm going to look at all the option spreads, and it's the same thing with all of these, iron condors and stuff. But let's just say you're looking at all these different option spreads, like, this one is, starting today, June 15th, you're holding into July 10th, right? This one's, you're holding into June 26th. Here you're looking at, all these different expirations for different stocks and so forth. But because this is bullish, you're looking for bullish seasonality. Well, it's impossible by hand to figure all this out. That's going to be crazy, right? Like, it'll take you forever. There's already 85,000 entries here. So here's the historical seasonality here for each spread. So historically from June 15th to July 10th, here you had a 66% historical seasonality return. This is the average. So this is positive, returns negative, and average. So how do we narrow them down, right? Here's one from June 15th, June 26th, and so on. So how do we narrow these down to the best ones? Because if you're just trying to do spreads with high seasonality, we need to narrow it down. So this is how we do it. We go to the seasonality screener, and we'll say this. For seasonality, I want stock returns, that they're positively 70% of the time for this time frame that we're going to be holding the spread. So that's going to scan out all the spreads here. So you see here from June 15th, starting today, June 19th expiration, 87% positive seasonality average return. Let's just say the average return is above 1%. Again, now I'm just narrowing down just to look at spreads that are around historically strong seasonal calendar months, right? So you could do other stuff here, but this is all I'm doing. And let's just come back to here. So, now we have like 4,000. If that's the only parameter we want, right? If that's the only parameter we want, we could say, show me the one that gives me the highest return if the stock gets up to the average, whatever this average return is, seasonal return. We could even do that. Show me the best one if that happens. So let's see what it does. So show me best return if the stock just tends to do what on average it usually does. So then what it will do is go and look at see strategy payoffs. So these are your payoffs if the stock moves its average seasonal return. So that's how you kind of narrow it down. Of course, you'd want to use other parameters as well, to clean these up. But that's the seasonality around if you're doing an option strategy for, particular hold period.
Excellent. We had a couple people on YouTube and actually one here. You mentioned you would look at someone's stock in the seasonality
Sure.
when you were looking at it. We had two on YouTube, Tesla and Google, and then we had one on our local chat on Zoom was asking for Roku.
Okay, so Tesla, Google, and Roku, right?
Yes.
So let's just take a look. Did they give you a seasonality?
No, they didn't give a time frame.
All right. Well, here's like from June 15th to June 25th. It has to default to something. So do like, it'll start to default. So here we see the historical seasonality period. But let's just do. Let's change this to. Let's go out to next month and see how it's done for the entire month. So here we see, and I think we did this one, the Tesla. So we see like for the entire month, from start to finish, historically, it's been a weaker seasonal period, right? But but we see here, like it tends to drop in the beginning. So these are the median returns. These are the average returns. So it tends to drop, kind of hit that around the first week of July, and then it does better. So if we did something like that, it looks a little bit better. That's from a historical perspective. Let's see, same thing with Google. Did any of them give you a range that they were interested in?
A date? No, I just asked for the Roku. They didn't give it a range.
Okay, so here's Google. So Google, July tended to do pretty good, 71. I think like it used to be a different symbol, Google, but here's how it did since like 2013, and we kind of see like it just kind of starts the month and just keeps going. So that look, at least from a historical perspective, that looks pretty good in Google. Let's take a look at Roku for the same period. So Roku, there's not enough data here. You only have 2 observations. So that's how it looked, but obviously you only have 2 observations. I don't know how long, Roku's been public, but
not long enough for the data.
So remember, this is a calendar period. So it picks a calendar period throughout the year and compares calendar period to calendar period. Yeah, so that's not that much data right now, but that's what happened in the last 2 years. These are the returns in the last 2 years. Over here, was there another symbol?
There actually, I'm texting back and forth. Well, actually not texting, chatting back with someone back and forth. They were looking at, now again, this stock may not have as much data, but it's one of the weed stocks, TLRY.
TLRY.
Yeah, Tilray.
About seasonality, what was the question?
It was to say they wanted you to input it into this same screener right here.
Yeah, so over here, the problem is like these, there's one observation, right? So
yeah, so
really
it's not.
You can't really compare.
For a lot of these stocks that have IPO'd in the last 6 months, there's not going to be a ton of information.
Yeah, there's not going to be enough, but the other things you could do is just say over like, you could look at its extreme moves, right? So if you're holding them, like for example, what was that, TLRY?
Yeah.
Yeah, it's not that much data. It hasn't been out that long, but let's just say if you're planning on holding it over a 5-year period and you just wanted to see like, what are its extreme moves? You could see here, like it hasn't been out that long, but it could really have some big extreme moves. Let's see when did this happen? So you could see here in March, this is this year, these are big moves this is over a 5-day period, especially in up moves as well. The up moves and down moves have been like violent in this stock. So, you kind of get a picture that at any moment, what may or may not happen.
We do. This has opened up a nice, we do have people asking, this is a bigger stock, so this should have some XOM. This is ExxonMobil, I think. And
Okay.
He's asking for the time frame. He's looking in July.
So he's looking like for what, like a seasonal pattern?
Yeah, seasonal pattern in July.
Okay. So let's just go back to the seasonality in July. So let's just see here. Now, of course, if something is going on, right, that's not typical, then you got to take that into consideration. So obviously we're in a coronavirus, oil prices are moving around. That hasn't happened before, right? So this is, we're only using it as guidance, as if nothing else is going on and what do we think typically may happen, right? That's what we're using it for. Since there's other factors now being into play that is not reflective in the data, in the historical data. We didn't have like coronaviruses here or what's going on. You got to take that into consideration. But let's just take a look here. Historically, it's been weaker. You know, XOM 75% of the time, it's been weaker in the month of July. It looks like really it just drops off right at the end here for whatever reason in July. So it hits like right, you know, right there. That's where. So let's say maybe, what if you did it a little bit early? Let's do like the 20th or something. So that's a little bit better. So it tended to kind of just, and it is volatile. You could see how it's moving around. It's not like it's straight up. It's moving up and down, and then just kind of drop right off here at the end of July. And let's just take a look at their standard deviation moves. So here, like, you know, these are your, you know, during that monthly period, you know, up or down 3%. This is the high and low from a historical perspective in the month of July. Same here, high and low. So that's what it would look like, you know, from a historical perspective.
Very cool tool. Very cool tool.
Yeah, just really quickly to answer like some questions that you may have.
A lot of questions about asking you to analyze stuff.
Sure.
So it's stuff I'm not sure. Can you tell a little bit about Qualcomm? How will this pan out approach? I mean, they're asking you for a lot of different ideas, which is not really what we're just trying to show the data here.
Yeah.
Someone's asking, how far back does this data go?
So this one here, if we have it available, this is going like right now 12, you know, I have it set to 12 years, but let's take a look here. I mean, I don't know. Let's see SPY. Let's see if let's test it out. I think 20 years it might go. So you got, you know, there you go, 2000. So if we have the data, obviously like stocks like Roku or Tilray haven't been out that long. But here's SPY going back like 20 years. So that's the data for 20 years.
$20 years of data. That's incredible.
For that season now, of course, you know, you have the ability to, you know, come in and see like how has it recently done. Right. So this is in the last 6 years.
You want to see the poll results?
Yeah, let's take a look at the poll results. So, okay, so that's pretty good. So like 70% of you have never used the seasonality statistics. So this might be, you know, something new, you know, to look at for a lot of people. So that's great.
And now it will live forever on our YouTube channel. So anyone can go back to us. Now, if you are on YouTube, please go to the bottom and hit subscribe. You'll be alerted to any new video Dimitri's putting out. I think it seems like one video a week, doesn't it?
Yeah, I try to put out like at least one video a week, and I base it off like where, you know, during that week when I have questions coming in, like in the emails, and I see some common questions come up, you know, I try to kind of focus on that. Either I'll focus either on that or like some maybe of the like newer features that we're introducing, then I might do something on like the newer features as well. But I try to put out just like one video guide, at least one video guide a week.
Yeah, so it is important to subscribe. I know we do try to get emails out. Emails sometimes get lost in the mass of your inbox, but if you subscribe to the YouTube channel and get the alerts, it's alerted right when they come out, so you'll get it right away. So even if you're on the Zoom meeting right now, I suggest you go over to the YouTube channel, MarketChameleon.com, and subscribe. Anything else there, Dima?
Yeah, no, I mean, unless there's any more last minute questions, or if you see any other questions.
Well, I don't know if you want to look at NVIDIA. Someone's asked for NVIDIA like twice.
Oh, sure. Seasonality. What's the question? Look at just the seasonality.
It just says NVDA, but I'm assuming the same thing. Historical
price.
Right,
yeah. Let's take a look. So here's NVIDIA. Let's expand it to 10 years. So this is what it looked like over the last 10 years. It's like 50-50, right? And it looks like, I don't know, it kind of goes like, here's the highest point. I mean, maybe if you narrowed it down a little bit, I could just use these markers. Let's narrow it down, right? Let's say we came in a little bit in July and sold it a little bit early. I don't know why, like at the end of, looks like towards the end of July, it tended to like get hit, but let's do the same thing here. If we narrowed that down, so we saw a little bit of an improvement. So that's what it was showing me. So it just like tapered off for whatever reason right at the end. That's what it did. So that's what it did on average using these observations.
Great. You want to? No one else is tossing out any symbols.
Okay.
Someone's asking about natural gas prices. Do we have any future plans of ever having a futures product? Someone's asking about natural gas futures. Someone's asking about corn futures. We just have neither Dimitri or I have ever traded in that space. So
yeah, that's like kind of a little bit outsider, but we are going to have a guest on and one of your friends, right? Well, who actually does trade in the metals, like in the I think he's in silver.
He's big in the silver space, which obviously has a futures contract, and he trades a lot of the underlying miners, mini miners. So he's got the SLV. I think he does some of the GLD as well. So he'll be on in the next couple of weeks. So, but I'm sorry.
No, go ahead.
So there are certainly ways to play. I mean, it's not on my radar, but as far as the natural gas futures, we do not have anything, but there are plenty of natural gas producers in the space that you can look at and do research on the Chameleon.
Yeah, we really didn't. Yeah, we never got into the commodities unless it was like an ETF listed commodity. But we never. I think I've been to the futures exchange in New York when we were up on the American Stock Exchange. Remember, there was the golden stuff and
the COMEX.
And I couldn't even I felt like I was getting a heart attack watching other people get heart attacks. I was like, it was too. The options were like nothing compared to they were just. Those guys were killers.
It was pretty interesting over there.
Yeah,
pretty interesting. Hey, would you mind stop sharing your screen, Dimitri? I'm going to put the disclaimer up right before we go. I didn't get to share. All right. So that is the disclaimer. You see that, Dima?
Yep.
All right. Just be aware, Market Chameleon is not a registered investment advisor or broker dealer. Either are Dimitri and I. And so if you have any questions, talk to a broker, a company that's a broker dealer. This is just for research.
Right. Just research, sharing ideas. We're not telling nothing we did today. We're telling you to go out and do. We're just kind of showing you the data.
Yep. Thought I would end on that. Hey,
all right.
Thanks for doing this, Dima.
Thanks everyone. Really appreciate it.
Everyone loves it.
Guys joining in and
yeah. And we'll do it again. And we'll do it again next Monday. And watch for Dima's videos during the week. They're great. Thanks for joining us.
Thanks, everyone.
Have a great night.
one.
Bye-bye.